Good afternoon and welcome to Money Control. This year, the market had all the plot twists of a Bollywood saga, minus the happy ending. The broader NSE 500 delivered practically nothing, while the Nifty 50 delivered a 4% return over the past year. But let's take a breath. If someone had told you that in a single year we would see tariffs from Trump administration, an India-Pakistan face-off, and an avalanche of foreign selling, most of us would have bet on a market crash, not just a 15% correction, which almost completely recovered. So all said and done, the fact that we are still standing, that's no small victory. As they say on Dalal Street, markets climb a wall of worry and sometimes they just take a nap. Now the big question, are we set for a reversal this year? Recent sessions have seen green shoots of optimism, but this year there is more than just sentiment at play. Earnings are expected to recover, valuations have cooled off a bit, and some of the last year's excesses have been shaken out. Remember, 2024's big sell-off wasn't just about foreign investors heading for the exit, it was also about earnings slowing while prices raced far ahead of fundamentals. This year, it's far more balanced market. At Money Control, we spoke to a whole bunch of market veterans, and here are some of the key takeaways. So as Prashant Jain puts it, the stage is finally set for a steadier and saner performance.
See, it is always tricky to forecast in markets 1 year. That's the nature of the asset class, that longer term is known with greater certainty than shorter term. But yet I feel that with this 15 months of time correction, with 2-3 rounds, the markets have withstood 2-3 rounds of FI selling. The earnings expectations are now quite close to reality. So I feel over next 1 year, this is my guess, I think market returns should be positive. What we feel is that India should grow between 6 to 7% foreseeable future, and medium term I think there is room for even 7% plus growth. See, India has been weak in electronics manufacturing, we know that. Right. But even there we are making good progress. In renewable energy, where we were weak, we are making good progress. In electric vehicles, you see now the vehicles being introduced by Indian companies, they are quite contemporary. So what we are saying is, in a nutshell, that we seem to be progressing well in our areas of weakness, where our right to progress, right to win was much weaker. And if we are doing well in these areas, I think there should be better progress in other areas of manufacturing. Government and industry are now working together. Government is pretty supportive of manufacturing. So we think that over time even manufacturing should progress in India. Services, we all know that story. And that if and when that manufacturing scales up, we think it should lead to 7% plus growth as well.
I am optimistic that the earning recovery will happen in the next 2 quarters. Very difficult to say whether it will happen in the next quarter, but next 2 quarters. And whatever channel checks which we have done, actually post Navratri, things have been really good on ground.
So if the tide's turning, where should investors be casting their nets? The answer, as always, depends on who you ask. But there is one rule everyone agrees on. This is a bottom-up market. In other words, don't chase sectors, hunt for stocks. Some companies will shine, others will sink, and it all comes down to picking the right horse. A sector that looks expensive has pockets of value hiding in plain sight, and the other way round too. Or as Maran Govindswamy of Unify Capital says, we should not overgeneralize India's market. We have bubbles, bargains, and everything in between. He points out that nearly 20% of the stocks today are cheaper than they were 4 years ago, and that's where surprises could come from. Think of it like Bollywood's Lagan moment. Everyone's betting on the continuation of some of the leaders of the last rally, but here on, the underdogs could just change the game.
If they're cheaper in valuation is fact. But should we buy or not should be driven by our assessment of their future
what the future
earnings,
is going to be like.
Right? There, I think India will surprise even the most optimistic guys over the next 3-4 years.
Okay.
In sectors which probably many are not looking at. Right? We always have a tendency to extrapolate the recent events.
Yeah.
So you might have seen people extrapolating the last 3-4 years government capex sensitive sectors earnings growth into future, like defense, right? Some companies could do, but sector as a whole to justify this growth, even though 9 out of 10 news flow in those sectors are positive, and you talk to 100 people, it's hard to find one or two guys who are bearish about the outlook for the sector.
Right.
But we should not confuse outlook of the sector with the earning growth of that sector.
Correct.
Right? And going and buying these pool of stocks at 50p, 60p, or several names at 100p,
Yes.
as against what they were at 15, 20p
Right.
3 years back, companies may do well, shareholders won't.
Right.
And therefore, you will find this 15% cheaper segment could be financial services, consumer goods, FMCGs, and some metal companies. The 25% fairly priced market could include IT, healthcare, pharma. They're not overly expensive. Maybe they're today as cheap or as expensive as they were 3-4 years back.
Right.
It is your outlook on some of these businesses in future. And in India, people tend to make assessment of a sector without realizing whether these sectors are homogeneous or heterogeneous.
Similarly, Kenneth Andrade of Old Bridge Mutual Fund has a contrarian view too. You've had everyone saying financials are the safe havens in the markets, right? And I have a super accomplished fund manager who does not own a single financial stock in his portfolio. No banks, no insurance companies, no asset management companies, no brokers, and no non-bank financial companies either. None at all. His reason is that the sector is getting fragmented and the growth won't be adequate to accommodate everyone with stellar earnings growth. Plus, he gives us 3 segments he is bullish on.
I think if you go back into history a little bit, when privatization of banking system actually moved out, there was a large opportunity for private banks, which happened. They got incremental amount of market share, or they got market share from the public sector.
That's right.
And when you got market share from the public sector, you showed disproportionate amount of growth, you showed disproportionate amount of profitability because you're more efficient. And I think that journey is behind us. Okay, and then if you look at the near term numbers that are there and see historical last 3, 4, 5 years, wherever it is, your incremental amount of efficiency of capital efficiency or ROEs have trended downwards. So profits increase, capital efficiency is trended downwards. I think that's what we've avoided, and that's what we tend to avoid. One of the largest exposures today is about pharmaceuticals.
Yeah.
And pharmaceuticals and manufacturing. Okay, manufacturing linked pharmaceuticals, which effectively is every company that is putting significant amount of capex to work for a marketplace which is bigger than 3% of India's GDP, for a population which is bigger than 20% of the world's population. That's a place that we are in. So effectively, it's generic pharmaceuticals, contract manufacturing, outsourced services, the entire gamut. And I think that's where it is. What do we see out there and where we are? I think I go back to our investing style, as it looks for a disproportionate growth in the total addressable market or the total addressable profit pool, and allocate capital out there. We are growing fairly well as far as demand for metals are concerned, whether it's domestic or international. We got cost competitive. We're cost competitive in nature. Obviously, there's an international price disrupt out there, so we are not very competitive on the export part of the market. But if you take out take the elephant in the room out of that, which is basically the Chinese, I think we're the second best in that industry. Now, that is something that we can't predict, but cash flows are protected. So if you look at the ferrous metal space or the steel space, I think we operated between 7,500 rupees EBITDA per ton to 25,000 rupees EBITDA per ton. I think we will be running close to about 13,000 rupees EBITDA per ton. So you're closer to the bottom of the entire cycle in terms of profitability. Even if you go back to 7.5, you won't lose money. in the life cycle of every QSR, this is the worst phase that they're going through for a very long while. So everyone puts it down to competitive intensity. Okay, everyone puts it down to fragmentation. Okay, the the moot point is that the industry can't get footfalls. Consumption, consumers, that category is struggling.
Right.
Okay, for multiple reasons, it's a struggling industry. That's exactly what we need to look for. So when a business doesn't do anything for 5 years, there's a misallocation of capital in some of these companies. They've been able to rectify some part of that all. Okay, we just have to wait for the cycle to actually play out. Unless you believe that the Indian consumers, which is basically a population which is 20% of the global population, is never ever going to come back.
Right.
Okay, because our long-term cycle, and this could go for every category under the sun, is at $2,500 per capita GDP. It has to go higher. Okay, and that creates a discretionary basket. Okay, which some businesses will benefit disproportionately from. So I think that's the cycle that we're looking at from a macro standpoint. From a micro standpoint, I think the profit pool could be significantly large out there. Now, which company is going to benefit disproportionately? We've taken our bets on a couple. It could be someone completely different, but it's not that these companies won't participate in that cycle.
What about the debate around large caps versus small caps? Well, even this is a bit of an academic debate, but the general sense is that large caps as a category are a better bet because they are cheaper, while they anyway have more sturdy businesses and can survive ups and downs much better. But here too, for stock pickers, it's important to see beneath the surface.
I feel that the large caps offer much better value than small mid caps in general terms. I mean, if you leave aside individual outcomes, the large caps I feel should be much better. When I look at Nifty, I feel the only place where there is some excess is still the consumer staples, maybe the consumer discretionary in pockets, the retail space, etc. But barring that, I think multiples are reasonable across the board. In the last 1 year, in the last 5 years, there has been a sharp reduction in excesses. What was very expensive has moderated, and what was very cheap is no more as cheap. So I think there is less sectors to choose from in this market. We are avoiding basically consumer staples, but otherwise most large cap sectors, we think the markets are reasonably placed.
When markets were at peak, probably 50-60% of the companies were in bubble zone valuation.
Right.
And 15-20% of the companies are cheaper today than what they were 3 years back. And maybe 25% of the companies are fairly priced. So you can always argue markets are expensive, looking at that 60% of the companies.
Right.
I can always argue that my pool of stocks are cheaper today than what they were 3-4 years back by looking at this 15-20%. Some people may add value by saying, okay, let's not overgeneralize whole market, because in the same market you have a pool of expensive stocks, a pool of cheap stocks. So we should not generalize whole market into one view. And therefore they may say large caps, mid caps, small caps. They may define the expensiveness based on the size of companies. And quite often you may have heard people saying small mid caps are expensive, large caps are not. Actually, if you take large caps, more than 35-36% of the earnings pool of large caps are at 10-12 PE, which is PSUs. And the balance 65% of the earnings pool are more than 30 PE. So index PE of 22 is hiding this extreme divergence.
Polarization between private and public.
And that polarization you find in small and mid caps. So it doesn't make any sense. Actually, it will hurt you to value companies based on size of the companies and rationalize their valuations. Instead, what is fair is to look at businesses based on those sectors' earnings growth and those
Sure.
sectors' value, PE multiple. And therefore, you will find cheap stocks in large caps as well as in small and mid caps.
Sure.
And you find super expensive bubble zone valuations in small mid caps, also in large caps.
You might want to think that because you can explain away a few performances basis short-term issues, the bigger lessons are learned when you break down the fundamental aspects of things, right? So the first principles. Now, if I take, say, a 5 or a 10-year rolling return, then the EPS growth and share price growth have always aligned, right? And if in September 24, for example, say exactly 1 year ago, in September 24, the 3-year CAGR for small cap index was 2x that much as of the earnings growth on a CAGR basis for the small cap index. Now the argument was very simple, right? That if the domestics are going to power the small and micro cap, and FIs are powering large and mid cap, then FIs leaving and domestics continuing to pump more money would have meant that small and mid cap won't crack as much as large caps. And when the correction set in September 24, till December 24, BSE 500 was down about 5%, but the small cap index was higher than what was in September. But then when the relentless pressure continued, at its worst, the small cap index corrected 25% compared to a 19% drop in the BSE 500. Right? So that tells you that eventually you can make up all these theories and narratives, but the true fundamental predictor of the market is the fact that your earnings need to come through, your cash flows need to come through. And in absence of that, you might want to have a fun ride now and again basis flows, but those don't often end in a positive note.
Well, now what are the themes that will perform going forward? Like I said, the themes that will do well going forward are not exactly sectoral themes. If you're looking for the next bag of multi-baggers, look for companies that can scale globally, those with leaders who have both hunger and horsepower. These could be great companies run by great managements that could take their unique offerings and accelerate growth by building a global footprint, or entrepreneurs who dream big, act fast, and often come from small setups. Short point, the next wave of wealth creation will come from those who can grow beyond their comfort zones. Listen in to Manish Chokani and Madhu Kela.
Analogy I give is when Japan came out into the world and became dominant, you saw Sony and Toyota and all these companies come here. Same way when Korea grew, you got their cars and you got their electronic products and so on coming. You're seeing the same thing now with China. If India is going to be third largest, we cannot think we are going to be third and then head towards second unless this happens. So if every country has done it, we are not going to be any different.
Right.
Same way generationally, like our generation grew up thinking, oh, let's get a good house and a good car, and kind of that's end of life for us. The next gen is coming, like what can we have impact on? Because their monetary needs are by and large fulfilled for many people, I mean not for the whole of India. But these guys are able to play that game. There's no dearth of capital. They are all kind of global citizens. Most of them have studied abroad. So today, what was the cut, copy, paste model of I could copy Amazon and bring it to India. I could copy, I don't know, Uber and bring it to India. The new gen is like, say a Zoho is saying, I will now build my own Microsoft Office.
That's right.
On the tech space.
Right.
But on the products and services side, now you think if LVMH could take European artisans and make them a global brand and make them an aspirational product, can, for example, a Titan out of India create Indian jewelry, Indian design, and take it and globalize it.
Right.
I'm not saying it will happen, but as an illustrative example.
Right.
Same way the Western model of healthcare has been curing your symptom with allopathic drugs, and mental health is something else. The Indian Ayurvedic system is something which is very integrated wellness. Is that something which can come out of India?
Right.
It may not be a Dabur, but will it be someone else who can take it and go out?
Right.
Same way, Indian services experience, which again, we think our hospitality is great. When you go to Europe and you go to US, you're horrified with your hotels experiences. Can the Tajes and the other hotels, I'm on the board of one of another hospitality company, can they also eventually scale up in India and then take that learning and globalize themselves as well? These are all things which will happen, and they are decadal plays.
Right.
And as you see then rate of change, you don't need a lot of equity. Once you're established, the cash flows allow you to compound from there, and the opportunity set is large. So there are enough across spaces, financial services again. Why do we think only Citibank or Bank of America can come into India? I know ICICI was out in the past, they withdrew. Can it be possible 5 years later ICICI, HDFC, SBI are seen outside as well in the region? So there are enough degrees of freedom. As the country will grow, this is inevitable, it will happen.
What I'm really bullish on, Mahalakshmi, on an incremental basis is not a sector, but a real theme, which because I travel a lot and I go to tier 3, tier 4, tier 5 cities.
Right.
And because I'm a prop investor, I'm very flexible to buy even smaller companies.
Right.
So some of these smaller companies which are coming from tier 4, tier 5, tier 3, 6 cities are actually, they are so exceptionally hungry and they've never got this kind of capital to invest into.
Is that a good thing or a bad thing?
It's a very good thing. Because at the end of the day, if you have capital and if you are real entrepreneurship, that is where your real journey starts, right? So in the last, let's say 4 years, maybe more than 1,000 companies have got listed in SME exchange. Now, they are not all the companies are good companies. Don't mistake me, right?
Right.
But there will be some good entrepreneurs and some good companies, and that is what our job is. So I am saying because of the openness of capital market, capital access has become real. Now it is our ability to find that entrepreneur who can access capital and is very, very strong in execution. I think over the next 3 to 5 years, that is what will make real return. And they will be across sectors. So right now we are actually just, overly busy or working really hard to identify some of these companies which are not very obvious to the world.
Right. You mean in the SME sector?
And
in the SME segment?
SME sector, SMEs, even in a larger space. This theme is not only for SME sectors. I'm saying that you saw so many of these new renewable companies got listed.
Yeah.
Some of them you have not even heard the names of.
Yeah.
And now they are taking at 5,000, 10,000, 15,000 crore market cap. They are the real entrepreneurs who have created businesses. And this all being created, Mahalakshmi, in last 5-7 years.
Now, there are other very powerful themes too. One is consolidation across sectors. One startling fact that Maran points out is that the size of the tourism industry in India is as big as the size of software services industry in India. Did you know that? Even more startling is that the tourism industry in Tamil Nadu is bigger than the tourism industry in Rajasthan or Goa, as you would imagine. And that's because of medical tourism. But tourism nevertheless. But tourism is not talked about too much because it is a very, very fragmented industry. So you don't have any representation in the index. It's unorganized. But eventually industries do consolidate. The top players gain greater share, and it is by spotting these companies that investors could actually win and gain from the structural growth.
For example, 10 years back, if someone had gone and told, you will find a hospital stock in Nifty, people would not have believed. Today we have.
Yeah.
Today we don't have a single hotel stock in index. Only recently one hotel company came into large cap index, but not in Sensex or Nifty. Maybe 10 years from now you will find. Maybe one, maybe two. So these are all sectors where it is obvious when you have 5 million, 6 million households coming from the 60 to 80 jumping above 80. And many of them jumping to above 90, you will find certain industry scale doubling and tripling over the next 5-6 years. When you have more than 10-15% in terms of volume growth in some of these businesses like entertainment, hotels, hospitals, consumer durables, home electricals, you will find many of these businesses are extremely fragmented, getting consolidated. So if you ask what is the largest hotel company's market share of the hotel industry, you will be amazed to find that it is hardly 4, 5, 6%.
Right.
That's the largest player.
Right.
And you will find several unorganized, small, marginal, regional players.
Right.
And you will find them fast getting consolidated. Something happened in broking industry.
Correct.
Right? In 91, we had 700 brokers in BSE.
Yeah.
Even 10 years back, there were 1,400 brokers in NSE. But what is the market share of the top 10 brokers 10 years back? hardly 14-15%.
Correct.
What
Today
is
the
it
top
last
player.
year? 65%.
Correct.
So the industry had grown 2-3 times, but the top 5 guys have grown 20-30 times.
Right.
You will find that happening in several of these businesses. So the industry composition and index composition will undergo a dramatic change in next 5-6 years.
Now another theme. While there is much hype around AI and AI stocks around the world are shooting up like rockets, the real gainers will be companies that could actually leverage the new technology to pocket efficiencies and also accelerate growth for themselves. Madhu Kela mentioned this theme. He did not mention any stocks that he is watching, but he said this is the new theme that he is actively trying to ride on in the secondary market.
There's one thing which I am really studying very keenly, that which are the companies which will disproportionately benefit because of the AI usage,
Okay.
and not the companies which are doing hardware for AI and this. That I think the scale of that benefit, Mahalakshmi, and the operating leverage because of this uses could actually be dramatically different in the next 3-4 years than what we have seen. And that entirely need not be passed on to the customer, because everyone will not use
an
AI
efficiency.
to
Right.
to that extent.
True.
So that is one thing which we are actually clearly and see, what if I told you internet in year 2000?
Yeah.
Would you ever believe that that one word can create $25 trillion of market value? Whether you talk of Google, Facebook, everything is a derivative
Right.
of internet, right?
Right. Right.
I feel this AI usage, I'm not talking about making investment in AI stocks. That
Right.
may be in a bubble
Understood.
phase.
Understood.
But this AI usage will continue. That is here to stay. And the companies which are benefiting out of that this could be financial companies, it could be drug discovery companies, it could be some SaaS companies, and that is what needs to be seen. Some of them are there in private domain, in which at least we are making investments very early on. And also here, if you see Indian market, Mahalakshmi has not yet appreciated that. Because on a $5.5 trillion market cap,
Right.
there is not even 20,000 crore rupees of direct AI plays or 30,000 crore rupees of direct AI plays which are there.
Correct.
This number is much higher in America or in China. The usage of AI for HDFC, ICICI Bank will be very massive in the next 3 years.
It can contribute substantially to earnings. you think?
It could reduce their cost base very meaningfully. And that is happening. I'm not saying that it is
Right.
already happening in the world.
Right.
Maybe we are few years behind.
Right.
But it's already happening in the world.
Right. Interesting. So financials, is there any other pocket where there can be disproportionate impact on earnings?
I think across sector hoga. If you just go to ChatGPT, they will itself tell you which are the 5 sectors which are actually likely to benefit.
Right.
But the question is, I would not go by sectors. I would go by, let's say, the companies which
Which
are
is more
very
progressive.
proactive, very progressive, and
Right.
which is why I am very hesitant to tell you that
Right.
this sector will do well.
Right.
I am saying that it is companies, and there will be two A and B. A, someone who will believe, go all out and start this, and B is someone who will still say, जब आएगा तब देख लेंगे. तो वो जब आएगा जब देख लेंगे उसके लिए कोडाक मोमेंट होने वाला है.
Now coming to one lesson investors often forget. A great company is not always a great stock. You might love the script, the star cast, the music, but if you bought the ticket after half the show is over or towards the fag end, well, what is the point? And in investing, it's not about just missing a big part of the movie. It could actually wipe out the good experiences of the past, meaning your past gains can get wiped out. Prashant Jain drives this home very beautifully. He expects sectors like renewables and electric vehicles to flourish, yet he owns none of these stocks. Why? Because valuations are too high. Manish Chokani also reminds us of the same point. It took Infosys nearly 10 years to reclaim its dot-com peak, not because it didn't grow, but because investors had already priced in the stock to perfection way back in 2000.
An industry may grow, but stocks may not grow if that growth is overestimated by the stock markets. So I don't think this is happening for the first time. And so we have to be careful where narratives driven in markets are narrative driven. And I think our approach to investing is to buy companies which can build a sustainable comparative advantage and they are available at a reasonable value. So I think sectors which are narrative driven in this market, I would be cautious. There could be individual companies which may do well still, but I think defense companies are not offering great value. There is growth, they are very strong companies, but we have to be mindful that these stocks have gone up 5-10x, in some cases even more in last 5 years. So I would do a very careful bottom up study before participating in that space. I think the solar, the renewable, the EVs, these are also sectors which have a lot of promise for growth. But some of these sectors I don't think offer meaningful scope to build sustainable comparative advantages by these companies.
What do you mean, and what do you mean by that?
See, if you are making
they are cyclical plays, you mean?
Not
so
cyclical, the industry will grow, but these are undifferentiated at one level, what you make. I mean, if you make solar panels or cells, so as more and more capacities come up, the country will win, but industry profitability can move lower. So that's why one has to be again very careful not to extrapolate the current levels of profitability. So I think this is a very good market in my opinion. Lot of capital is being raised, lot of capital is being provided to entrepreneurs and across the entire risk spectrum. So I personally feel in most of these issues, the long term outcomes will be much below the expectations of investors, but it will be great for the country because capital markets are rewarding entrepreneurship, and even out of 100 entrepreneurs who get money, if even 5 or 10 do extremely well, they scale up, the country wins. But it is true that there is so much supply and this has not allowed the markets to move higher,
right,
which again I don't think is bad particularly, because if there is so much money coming to the market and there is no supply of stock, if this did not happen, then the markets would have been
even higher,
and multiples would have gone to unreasonable levels, and you have not created any capital. You have simply driven existing prices higher. So I think this is a good market, but of course each one has to be careful as to where they participate in this market. At the same time, there is no supply of new stock in Nifty. The entire supply is outside Nifty or maybe even outside large caps by and large.
Right.
So I think that should be one more reason how as a category large caps may, in my opinion, catch up with the small mid cap returns.
Because the supply side is weak.
Supply is just not there. It's hardly, I mean, there are few large cap companies that go public once in a while, but relative to the share of market capitalization of large caps, the supply is much small.
Weaker.
When the theme is so well known, question is the market missing anything?
Correct.
Or are they priced for good execution?
Right.
In most cases, I think they are priced for perfection in execution and they can't afford any deviation there.
Right.
Which is why you see when some companies give you results which are maybe 5% below expectation, the stocks plummet by 15 or 20%. And the reverse happens in cases where companies beat expectations by even 2-3% and the stocks are up 5 or 10%. So it's really about expectation versus reality. And in places which are well discovered now, I would submit, the sectors you're mentioning are of that type.
Correct.
The sectors will do very well, no question. But what the stock prices will do is a different question. I often give this example of like when the IT boom was on in March 2001, our best company Infosys had already reached a $45 billion US market cap. 24 years later, we are probably at 80 billion. So it's not even doubled in dollar terms in 24 years.
Right.
So you may buy the best company, but you get the pricing wrong and you don't make money. The company, the business, of course, has done really well.
Right.
But as a stockholder, it was your mistake that you paid a foolish price. I look for asymmetrical bets. The mantra I've given my child is easier than what Nimish Bhai had given me. He said, when you buy a stock, only pull the trigger a few times. But can you imagine this company's profits equaling its market cap? Even if it takes 10 years. Even if it takes 10 years. If you can't imagine it, the market will never have imagination and terminal value for this company, right? If you can think of that and that makes you start thinking about the business for 10 years, then you buy it because you're an owner of a business. You're not a stock trader for buying for the next 6 months or 2 weeks or whatever. I've made it easier for my son. I said, think, can the company you're buying today, can it be a 5 PE based on what you're buying in a 5-year horizon?
Okay.
If you think of it logically, that means if it's a 5 PE in 5 years, your worst scenario is the companies we buy will never be below 15 multiple.
Right.
And I don't think long-term stocks survive more than 25 multiples.
True.
Which means you'll make 3 to 5 times in 5 years,
Right.
which is a good rate of return.
Right.
But if you can't see out for 5 years in the business, why are you buying it? Because you could be buying in momentum that, this platform company is taken off and it's growing 100% a year.
Right.
But in 5 years, if it's still going to be a 40 PE,
Right.
what are you betting on?
Right.
So if you think of, basics like how a businessman would think of payback for his
Right.
money.
Right.
Because eventually we are owners of businesses.
Right.
And we should act like we are owners of businesses.
Right.
And that 5 multiple represents a 20% return on your capital.
Right.
And I can wait for it for 5 years. After that, I want the business trajectory.
This year, while equities were rehearsing for their next act, gold and silver stole the show. Gold glittered with 61% returns, while silver went full Doom 3, stealing hearts and headlines alike with a 78% jump. But here is the twist. Much of that last leg was driven by inflows into gold ETFs, the kind of herd rush that gives old-timers deja vu. In markets, recency bias is the villain. It makes us believe every rally is forever. Gold, of course, is the eternal diva, sometimes dazzling, sometimes distant. It has no earnings, no balance sheet, no logic, just plain, simple faith. And as history shows us, it can stay quiet for decades before making a grand re-entry. Or let's just say gold doesn't perform every year, it just waits for others to mess up. But since the world is still messed up geopolitically, it will continue to rise.
Gold, silver have no intrinsic underlying cash
Right.
paying properties. They don't give you a dividend, they don't earn any income. So in that sense, it's all a kind of store
Data
of
fools
value.
theory.
It's a store of value theory because you've got thousands of years of history
Right.
of
Right.
gold being a store of value and humans valuing it. And we joke actually at home that those who are over 50 think of gold as the store of value. Those who are 30-ish and below think of Bitcoin as a store of value
Right,
because the governments
right.
can't produce it.
Right.
And which of these two will eventually win? Well, these are all articles of faith. It's like
Correct.
when you buy a painting, if you think I like a Hussein, whether it's, you can't say it's 4 square feet and therefore it's worth 40 lakhs. It may be worth 40 crores. It's
Correct.
eye of the beholder.
Correct,
If
correct.
enough people believe in it, which seems to be the case now with gold and with bitcoins, they both seem to be creating markets of their own. But certainly the belief in the existing fiat currencies of the dollar or the euro or the yen or the pound has certainly started going into steep decline.
Right.
Like you've seen a steep upturn in some of these assets, I think the day will come when you will see a steep decline in some of these currencies. Like, would you have imagined the Japanese yen going from 100 to 150 to the dollar?
True.
Unimaginable.
Correct.
But it happened. It's happened in our lifetime.
Yes,
And
yes.
none of us could have predicted it.
Yes.
But same way, what does gold fall against? What does the dollar fall against? So if people are looking for an alternative to that, it will be against some of these hard assets. And why is Trump railing against the BRICS? Because he knows the most likely counterbalancing force in the world is going to be these economies. Because the rise of Brazil, China, Russia, and of course South Africa is no longer in the game, but Saudi seems to be the new player in town over there. And you will not trust a currency issued by any of these people. But if they say, I will settle eventually the difference in gold, then the game is on.
Right.
So how this plays out is like Lenin used to famously say, nothing happens for decades.
Right.
And then decades happen in weeks.
Sure.
We seem to be heading in that direction.
So while as an asset class, gold and silver do deserve a place in your portfolio, be prepared for a pullback, because it's just common sense that if something goes up so sharply, it will see some pullback, but it's hard to say when. By the way, the sudden pullback last week should be a warning sign that these long-term store of value could also see steep declines.
Gold is a fear trade.
Right.
Last 1 year, there was only fear in the world. There are war, there are geopolitical, trade barriers, what could happen. There was dollar debasing, there are lots of fear. And gold works when the fear is maximum.
So that's all the big picture view I have got for you from Market Veterans. We also have a bunch of stock ideas, recommendations by brokerages for the year ahead. Nandita Kemka and Lovisha Darad spoke to a number of analysts through last week, and here is a quick summary of what they gathered.
Samvat 2081 may have been a muted year for markets. But as we step into Samvat 2082, investors are hoping for brighter fireworks. Across the street, experts agree the coming year is all about careful stock selection, diversification and capturing stock-specific opportunities. So which themes and stocks could really light up your portfolio in the coming year? Let's dive in. Despite global headwinds, India's domestic story is resilient. Across our conversations with 5 top brokerages, a few key themes stood out. Financials and consumptions are expected to benefit from earnings recovery and supportive policies. Manufacturing, infrastructure and defence could see strong growth on government spending and capex momentum. Mid-caps and selective stock plays may deliver outsized returns. In short, Samvat 2082 is shaping up as a year where stock-specific opportunities matter more than index-level moves. In fact, across brokerages, analysts are highlighting a mix of high growth, consumption-led and domestic champions. Stocks, they believe, could deliver festive season fireworks for investors. Let's take a closer look at their top picks. HDFC Securities calls its picks rockets ready to take off. Among their picks are the likes of MSTC, the digital auction powerhouse, trading at 13 times forward earnings. The target price outlined is at 673 rupees. Northern Arc, a diversified NBFC benefiting from liquidity and rate cuts. The target here is at 333 rupees a share. Sheela Foam, a turnaround mattress play, riding rising consumption. Moving on to Motilal Oswal, the brokerage gives us a festive, sweet twist. Swiggy, the anar of the market with profitability on the horizon. Axis Max Life, the safe and bright Fuljhari powered by Axis Bank's distribution. Indian Hotels, the Kaju Katli of hospitality, boosted by domestic travel and MICE events. And a bonus pick from Motilal was LG Electronics India, the atom bomb of consumption. Moving on to Anand Rathi, it sees mid-caps leading the fireworks. Their Diwali picks include BSC, the capital market firecracker, riding IPO momentum and the derivatives growth going forward. FIAM Industries, shining in auto and ancillaries and EV lighting solutions. BlackBuck, a digital logistics platform unlocking growth through tech adoption. Moving on to Asit C. Mehta, which offers a festive thali of strength, spice and color. JK Lakshmi Cement, a solid performer with strong capacity expansion. BKG Foods, twisty but delightful, capturing rising consumption in Tier 2 and Tier 3 markets. Kansai Nerolac, ready to add vibrant color to your portfolio. And lastly, Geojit Financial Services reminds us that diversification is key. Bharat Electronics, a defense powerhouse with a robust order book, is among its top ideas. Zomato, now eternal, led by Blinkit, making a strong comeback in quick commerce, is also on their top picks list. Lastly, they like Jio Financial Services, the Reliance BlackRock joint venture, creating long-term value. So what's the key takeaways for investors? Across all brokerages, a few points stood out. Domestic consumption, financials, manufacturing and defense are likely to drive returns. Mid-caps and selective stock picks could outperform broader indices. Whether it's rockets, Fuljaris, Kaju Katli or colorful comeback stories, Samvat 2082 promises a festival of opportunities for those who stay strategic.
So those were the stocks and themes for the year ahead. Here is a quick pataka round which should give you a sense of all the buzzing stocks of last year and what they are likely to do in the coming year.
Hello and welcome to Moneycontrol's special segment where we take you through 10 stocks that have taken investors by storm in the previous Samvat. While some have been rockets in investors' portfolios, other stocks have fizzled out. So let's look back at our 10 names for today. Lavisha, what's the first one that you have for us?
Well, we'll talk about the first stock that is in focus, and that's a new age stock. That is your Swiggy. The stock did debut bourses this Samvat, and it was a tepid listing. But then we did see that the stock swiftly went up by 20% in the span of 1 month. The stock eventually also hit a record high of about 617 rupees per share, because investors rewarded that growth story of this novel tech theme, and optimism and expectation has been quite strong that the company will be capturing a larger share of the consumer's wallet. But then we also saw that the counter hit about a low in the month of May, when the 6-month lock-in period did expire and non-promoters unlocked the counter to sell as well. But even in the March quarter, that was a disappointment for Swiggy, and the losses had doubled, and investors feared that the company could be a victim of the high cash burning phase as well. But yes, the turnaround did happen from May lows, and now the stock is up by over 40% from its May lows, given that the revenue has risen by annually and sequentially basis as well. And though the company's first quarter performance has also been on a swelling losses, but the management recently said that their stake sale in Rapido will help cushion cash burn by this one large time inflow as well. So yes, now going into Samvat 2082, analysts will be expecting the upcoming quarters to reflect the reduction in losses, and the brokerage houses have also anticipated continued tailwinds in the food delivery growth as well, which could be augured well by the festive demand. So some stabilization and improvement could be expected in the quick commerce business as well. The company has also strengthened its food delivery outlook, and it has raised its growth estimates to nearly 23% for FY26 to FY27 as well. So that's a good stock coming in from there. And, I believe, Zoya, the next stock from you will be its competitor as well.
That's right, Lavisha. So, since its debut on the bourses, Swiggy has had quite the roller coaster ride. Not just Swiggy, but its closest competitor, Eternal, has also had quite the year. The rebrand from Zomato to Eternal was something that the street did not expect, but with the company's Nifty 50 debut, it's now a name that nobody can really forget, This year, more than the food delivery business, experts and analysts were extremely positive on the quick commerce front. In fact, for the first time ever, Blinkit's average order value jumped far ahead of Zomato's. So while the food delivery segment does remain a very profitable anchor, Lavisha, Blinkit's rapid ascent in orders, order value and valuation has marked a very strategic pivot in Eternal's playbook. Going ahead, especially after that Q2 show, Eternal has flagged that there could be slower growth recovery, and the management has also hinted at a softer discretionary consumption environment. All this combined may damage investor sentiment.
All right, now shifting focus away from Swiggy and Eternal, let's go on and talk about the stock in focus, that is your HDB Financial Services. It was one of the first mega IPO that hit markets this Samvat as well, about 12,500 crore rupees of the issue size, and the IPO received about 17x subscription, which was led by a strong institutional demand for the NBFC player. Now, this is also the biggest NBFC IPO which got listed on the bourses with about 13% premium, crushing the skepticism that the investors had towards large issuances also. And it also became one of the 8th most valuable in NBFC with about 70,000 crore rupees of a market cap. Now, investors are betting on this company as they like that it has crossed about 1 lakh crore rupees in OM value without having any need of external capital for the past 8 years. So that is quite a notable achievement, given that the major IPOs that have hit the market, they've still been incurring losses or facing profitability challenges as well. But if you look at the stock performance, that since then, from the listing price, HDB Financial has dropped about 16%, and it is also trading below the IPO's upper price band as well, because there are some concerns in the street over sector-wide pressures on credit costs and some margin issues as well. But as we step into the new Samvat, what the street will be watching out for, some key monitorables will be the company's disbursement trends going forward after their second quarter results have showcased a good loan growth, and net interest income growth will also be some of the key monitorables as well. The OM has given out a year-on-year expansion of about 13% in second quarter, while interest income on the other hand has risen by about 13% on a year-on-year basis. So yes, that is one stock that will be watching out in the upcoming quarters this Samvat as well. One of the biggest IPOs, but yes, some tepid listing and some faltering returns since its listing price.
That's true. Well, Lavisha, who can forget that the excitement HDB IPO brought to Dalal Street? Since we're talking about the financial pack, let's talk talk about one of the most watched stocks on the bourses this past Samvat, which has been IndusInd Bank. Now, we all know that IndusInd Bank has had quite the year. With alleged fraud concerns, accounting discrepancies, and the management reshuffle, the bank stock has taken a very sharp beating and sunk nearly 50%. The incorrect accounting of internal derivative trades has had a nearly 2,000 crore impact on the bank's net worth. Not just that, but there was also a probe into a 600 crore rupee discrepancy in the bank's MFI portfolio. Well, based on SEBI's interim order, the bank's management was actually aware of this derivative discrepancy about 15 months before the lender disclosed it to the public. This has led to a rejig in management, and it goes absolutely without saying that investors were not happy about this. Nearly half the stock's MCAP has been wiped off since then. But going into the new year, this bank could actually be slated for a turnaround. Brokerages are turning positive on IndusInd Bank. In fact, Morgan Stanley recently upgraded the stock amid inexpensive valuations. Further, the broking house added that the clarity over the management after the new CEO appointment is also a very key positive. In FY25, the bank might end the year with a very clean balance sheet and strong coverage ratio.
All right, that was IndusInd Bank for you, Zoya, and of course we'll be watching out for the figures, how it closes, how the stock closes for this year as well. But yes, adding another name from the financials pack, let's also talk about Tata Capital, one of the biggest IPO of this year, which had an issue size of about 15,000 crore rupees. Now, the IPO did garner about 2 times of its subscription, but it failed to make an impressive debut on the bourses. It debuted about flat on the exchanges. Now, the street has been divided on why did Tata Capital, which carries the brand value of Tata Group, started on such a polite note. The skeptics believe that there was no immediate growth triggers which was visible for the sector, which is why it failed to keep up with the market hype. Well, some have argued that the peers operating in the sector has underperformed as compared to last year, and that's what has failed to keep up with the enthusiasm as well. But yes, so what the optimists have been arguing, they believe that this is just a short-term picture and the long-term investors should keep on holding the counter as well. Now, some of the key triggers which they believe will hold well as we step into the new Samvat, that is, the investors should watch out how the management commentary on growth outlook looks like, understand the loan book growth trends, and it's given its diversified presence across the retail, corporate and housing finance segments, it still is quite a compelling play in the India's financial services segment. But yes, amongst that, Tata Group stocks that have been in focus this Samvat. And Zoya, off to you to another Tata Group company.
That's right. Speaking about the Tata Group, let's talk about Tata Motors. The stock has had quite a bumpy ride. The year gone by saw Jaguar Land Rover trimming its guidance amid Trump's tariff wars, which clouded the luxury auto player's sales outlook. Further, Tata Motors' demerger of its commercial and passenger vehicle arms has caught the street's attention. The management had decided to spin off the commercial vehicle arm into its own listed entity last year in order to sharpen the business focus and capitalize on growth opportunities for both the firms. Going ahead, analysts are very bullish on the passenger vehicle arm as they believe that the momentum for the passenger automobiles has picked up pace after the GST reforms and festive and pent-up demand has come in. Further, since the passenger vehicle arm includes JLR, the outlook remains bullish and analysts are very positive.
That's right. You know, Tata Motors, while the GST cheer is on, but the weak wholesales data that came in from JLR is something that we'll be keeping a watch out
Exactly.
for. But yes, shifting focus from Tata Motors, let's also talk about the blockbuster stock of this Samvat, and it is a recently listed stock, none other than LG Electronics. Now, the IPO has received several milestones. First, the IPO was oversubscribed by about 54 times on the final day of its bidding, amid the strong participation which was seen from the institutional investors. With this, LG Electronics also became the most subscribed public issue in the Indian stock market, and it has beaten the record which was earlier held by Bajaj Housing Finance. Now, since the IPO was entirely an OFS, the proceeds will entirely go to the promoter selling the shareholders and will not be received by the company. But apart from this, the stock has a blockbuster listing of about 50% premium to the issue price, and it has received a consensus buy from the street as well. Now, the 4 factors that have impressed the street was that the counter was reasonably priced. Second, it operates in a sector where it is a leading player. Third, it is amongst the top brand names in the country. And fourth, it has a legacy of being in India for the past 66 years. So as we step into the new Samvat, investors will be watching out its growth story, understand whether the stock warrants such valuations, and some demand trends in the consumer appliances sector, which also be tracked after the GST rate cuts.
Well, that's right, Lavisha. Who can forget that 50% listing pop for that LG debut? It took everybody by surprise. Moving on, I have another Tata Group stock to discuss, that is Trent. Now, early in 2024, Trent was Dalal Street's darling, with analysts and experts remaining extremely bullish despite lofty valuations. However, the past summer was not too kind to this stock, which has taken a sharp 40% stumble on the bourses. Trent's current run rate falls short even of management's aspirations of 25% growth for the next few years. Further, the Q2 business update that we saw meant that Trent has marked 5 consecutive quarters of a sequential slowdown. As valuations have turned too demanding and the revenue growth pace has slowed, falling short of management's aspirations, we've seen the target cuts and downgrades come in rolling. But in the future, with GST cuts posing as a key tailwind for value retailers and Trent's very strong store additions, brokerages are very hopeful for a turnaround based on Trent's multi-pronged growth strategy.
Another Tata Group company,
That's
and
right.
they have been quite buzzing this Samvat as well. But yes, let's shift focus and talk about Yes Bank, because this Samvat, that lender has witnessed the largest cross-border investment in the Indian banking sector. We did see Japanese lender Sumitomo Mitsui Banking Corporation winning RBI's approval to acquire nearly 25% stake in the company 5 years after we saw the clutch of banks rescuing a Yes Bank as well. Now, the stock this Samvat has delivered about 9% returns, and much of its outlook is going on to how the Japanese lender plans to scale up the corporate and trade finance businesses. But yes, the entry of SMBC establishes a new precedent for the future of foreign acquisition in the India's banking sector and enhances the corporate governance standard as well. So yes, this is something that we'll be watching out for. That is your Yes Bank.
Yes Bank, yes to Yes Bank is said by Japan. Now, once a street darling, the last segment that I have for you today is the Nifty IT Index. The domestic information and technology pack has seen a very sharp fall from December 2024 highs. This pack has been hammered by H-1B visa concerns and tightening discretionary expenditure from global firms. Clients from major markets like US and Europe are becoming more cautious about their tech spending as a result of the ongoing economic uncertainties. Adding to that, the recent hike in H-1B visa fees in the US has sparked worries about higher operating costs for those Indian IT companies that have a very strong on-site workforce there. It's also fueling concerns that the US could, going ahead, implement more protectionist and nationalist measures, which isn't helping the investor sentiment either. Globally, firms are focusing on cost optimization plans and undertaking massive layoffs, which is making the outlook for the domestic IT players even more cautious. While the Nifty IT index has stumbled deep into the correction territory this year. And for the upcoming Samvat, while shares of Nifty IT firms are approaching their long-term average valuations, brokerages are still awaiting strong earnings growth momentum. In the near term, there aren't many triggers for margin expansion. However, we still hope that the new Samvat can turn this ailing segment's fate around.
So we are now at the end of today's edition. This Samvat, the message is clear. Don't chase noise, chase the nuance. Markets are maturing, investors are smarter, and the next big winners may already be in your blind spot. So look harder there. Enjoy the Festival of Lights and best wishes for a sparkling portfolio and profitable trades in the year ahead. And wish you all a very happy Diwali from all of us at Moneycontrol.